Many of us may have read in class about the idea of compound interest. Nevertheless, we did not fully grasp the significance and importance of compounding until we began managing our finances as working adults. Understanding how the power of compounding works can help you plan for major life milestones, as well as increase the return on your assets and savings. With the help of the snowball effect, which illustrates how a small snowball grows larger as it rolls down a hill, it is possible to better comprehend the power of compounding. Similar to this, the ability to compound increases your savings by adding more interest to money that has already been earned as interest. In other words, the strength of compounding results in what is referred to as exponential growth, when both your account balance and the rate at which interest accumulates over time are rising. Compound interest is a very effective method for increasing your money over time. Basically, it is the process of earning interest on interest that has already been earned. Your investments can grow rapidly with compound interest, but there are risks involved. It's critical to comprehend the fundamentals of compound interest and how to take advantage of it. Welcome to our YouTube channel. Today, we'll discuss compound interest and how it might help you maximize your investment. In order to receive the most recent information on subjects like this, please like and subscribe before we continue. Compound interest is one of the most powerful concepts in the world of investing. It is the idea that when you earn interest on your investments, the interest itself can then earn interest in turn. This compounding effect can lead to exponential growth in your investments over time. In essence, the power of compounding is the act of adding interest on interest, meaning that the amount of money you invest will result in earnings from both the initial principal amount and the cumulative earnings from earlier compounding periods. In the end, the force of compounding aids in the gradual growth of your money. Leading banks and commercial institutions provide a variety of investment alternatives around the world that credit compound interest on the money you invest. These investment plans typically feature a set term for compounding, such as a yearly, monthly, or even daily interval, allowing you to take advantage of compounding's benefits as needed. There are other investment options, including fixed deposits and mutual funds, that reinvest your money's earnings over time, whether they come from capital gains or interest, to help produce new earnings. Suppose you put $10,000 into an account with a 5% yearly interest rate. Your initial investment would increase to $10,500 after a year. Your investment would be worth $11,025 if you reinvested the $500 in interest you earned and kept earning 5% annually after another year. The force of compounding becomes even more clear with time. Your $10,000 initial investment would have increased to $16,386 after 10 years. After 20 years, your investment would be worth $27,126 if you kept investing the interest. It is greater than your original investment. The most exciting feature of the power of compounding is that your assets generate interest on both the initial investment and any prior interest. Overall, the ability of compounding aids in the development of a wide base, which increases prior earnings with each cycle. So, as an investor, you must keep in mind that the power of compounding comes from its capacity to reinvest returns on your investment. In other words, you shouldn't try to extract your earnings before the investing time is through. Time is the key to utilizing compounding's interest advantages. The compounding effect is stronger the longer you let your investments grow. For this reason, it's crucial to begin investing as soon as you can, even if it's just a tiny sum. The more time you have to take advantage of compounding's potential, the sooner you should start. So, as an investor, it is important to remember that the power of compounding comes from its capacity to reinvest returns on your investment. In other words, you shouldn't try to cash out your returns before the investing period is over. If you did not, you might run the risk of restricting compounding's ability to increase your profits. Your financial objectives and investing capacity should guide your decision regarding the investment plan and time frame. The further you want to go, the sooner you need to start investing, so you have time to build up the appropriate quantity of wealth. Choosing assets that provide a decent rate of return over the long term is also crucial. While it may be tempting to seek out investments with high returns, it's crucial to keep in mind that these assets frequently have a higher risk. It's critical to strike a comfortable balance between risk and return. So how can you improve your savings with compounding benefits? First of all, you must start early to take full advantage of the power of compounding. Like with other good endeavors, you must begin your investments early. The power of compounding, for instance, can help your savings increase dramatically over time if you start investing as soon as you start earning money. While doing this, keep in mind that the longer you hold on to your investments, without taking any money out of your returns, the more room you give your money to grow, because compounding's power only gets stronger with time. A longer investment horizon allows you to take advantage of time and increases the likelihood that interest will be earned on your investments. To comprehend the effectiveness of compounding, let's look at one example. Paul and Alex are the same age. When Alex was 20, he made a $10,000 investment in a business that offered a 5% yearly return. The initial investment would increase to $27,126 by the time Alex is 40 years old. Paul, on the other hand, began investing when he was 30 years old. He too invested $10,000 and saw returns of 5% each year. Paul will only make $16,386 when he is 40 years old. This is the strength of compounding. The interval or frequency at which the interest multiplies is another important component of compounding's power. Compounding can occur daily, monthly, quarterly, biannually, or annually, among other frequency possibilities offered by various investment alternatives worldwide. The impact on your assets increases with the length of the compounding interval. Let's take an example where Paul invests $120.82 in two different investment types over a 3-year period. The first investment option offers a return of 7% compounded annually, while the second offers the same rate of return but at 7% compounded quarterly. The first investment option was worth $148.01 at the end of 3 years, while the second was worth $148.78. As a result, it is clear that shorter reinvestment periods yield more impressive returns than longer ones. In general, you can observe a more noticeable change in your returns as you increase the frequency of reinvesting or compounding. As you can benefit from a higher rate of return over a longer period of investment, it is advised to invest in equities if you have a lengthy investment horizon. To learn how the power of compounding can boost your returns across various investment periods and interest rates, there are many newsletters and courses available that provide instruction on the subject of compound investing, because it is something that many people are eager to know more about. Examples include Investors Underground, Stansberry Research, and The Motley Fool. Another important fact to know is that you must first establish your priorities and practice discipline when it comes to investing if you want to build a strong and successful investment. Hence, in order to maximize your investments, you must try to exploit the power of compounding. Regardless of your income, you must set aside some time to determine your preferences and goals. By doing this, we'll be able to comprehend the advantages of long-term, regular investments and how the power of compounding would be put to use. At the same time, you wouldn't be easily persuaded to take premature withdrawals that could harm the potential growth of your fund. Instead of focusing on rapid profits, you should give your investment plenty of time so that, thanks to the power of compounding, it can develop into significant wealth. You might not be as financially astute as an experienced stock investor, to put it mildly. You shouldn't, however, assume that the power of compounding is inappropriate for you, as stocks are a volatile asset type and don't offer return guarantees. You might find it challenging to invest primarily in them. The upside of stock investments, though, is that they have historically outperformed all other investment options and asset classes in terms of long-term inflation-adjusted returns due to the power of compounding. By using a stop-loss approach when trading with equity, you can limit your losses. Otherwise, you run the danger of losing a large amount of your investment. You might be able to optimize the benefits of compounding by investing in direct stock and equity mutual funds. These investments are, however, also susceptible to fluctuations in the market. If investing in high-risk ventures is not your strong suit, you may want to consider other investment opportunities that provide a more stable, fixed rate of compounding returns. The first type of investment is debt, which enables you to obtain consistent returns through fixed interest-producing assets, including corporate bonds, treasury bills, government securities, and commercial paper. The pension system is a second option that you can research. Pension systems are essentially long-term retirement-focused investment opportunities that effectively leverage the power of compounding. They do this by combining investments in equity, fixed deposits, liquid funds, corporate bonds, and government funds with investments in equity, fixed deposits, liquid funds, and government funds to help you benefit from compounding. Bank fixed deposits are one example of a long-term investing strategy that enables you to build wealth through compounding. The advantages of using the power of compounding to support your long-term financial goals are immeasurable. You can quickly maximize your investments and savings. To avoid limiting your investment's ability to expand, all you need to do is get an early start and exercise patience. Therefore, to really benefit from compounding, you must keep your investment in place for a long time. In the world, there are a number of investment choices, such as fixed income and market-linked products, that can provide compounding gains. You can also receive substantial tax advantages when you invest. By doing this, you may simply increase your savings by lowering your tax obligation, ensuring that you stay on course for a lifetime of disciplined long-term gains, thanks to the power of compounding. You can choose unit-linked insurance products to receive tax benefits and protect your family from any unforeseen circumstances. A unit-linked insurance plan can assist you in protecting your family and give you the chance to invest in the money market based on your risk tolerance. Overall, by limiting risk and keeping a long-term perspective in mind, you may maximize the potential of compounding on your assets. Last but not least, keep in mind that compound interest works both ways. The compounding effect might work against you if you have debts that are accruing interest and cause your debt to expand exponentially over time. Hence, it's critical to settle high-interest bills as soon as you can. In conclusion, the astonishing phenomenon, known as the power of compound interest, can over time cause your investments to rise significantly. Compound interest works in your favor if you start investing as soon as possible. Look for options with fair rates of return and refrain from racking up high-interest loans. By doing this, you may maximize the wonder of time spent investing. Hopefully, with the tips we've shared, this compounding may become easier for you. Keep these tips in mind, and you will be well on your way to accumulating wealth. If you enjoyed this video, please like and subscribe. Thank you for watching.